What's a company that's had a large impact on our daily lives but many don't know about? At one point, its rise paralleled Tesla today. More than a hardware tech company, they were going to change the world. And they did. The way we do business today wouldn't exist without the internet, and your internet today wouldn't exist without this company. Which company are we looking at in this video? That's right, you read the title, Cisco. Hey everybody, and welcome back to Dollars and Cents, helping you make sense of making dollars. In 1984, Stanford computer scientists Leonard Bossick and Sandy Lerner founded Cisco with the goal to create a device that would allow computers at the school to talk to each other. The blue box that they developed became the foundation for not only the company, but also the internet revolution. Cisco became the backbone of the early internet, producing wildly popular routers that could support multiple network protocols. Their creation allowed for the interconnection of computers on a massive scale. In early 1990, Cisco was listed on the NASDAQ at a $224 million valuation. Just 10 years later, in March 2000, the company soared to a market cap of $569 billion, making Cisco the most valuable company in the world. Then, the tech bubble burst, causing many of the high-flying tech companies to come crashing down. Cisco took a hard fall, plummeting from $77 per share to less than $10 in just under 2 years. Despite this titanic sinking, Cisco continued to provide incredible innovation in all areas of internet architecture, pioneering the Internet Protocol, or IPs, to the Ethernet in the early 2000s. Even in recent years, Cisco has been busy. Not only has Cisco divested parts of its business, but it's also renewed its focus on the Internet of Things by investing large sums of money into companies like the Alchemist Accelerator, Everything, and even acquiring a company called VeloCloud. Now that we have this short history, let's get into Cisco's finances. As always, we begin with revenue growth. While Cisco is growing, it's a slow growth. In 2016, revenue stood at $49.25 billion. At the close of 2020, the revenue had only grown to $49.82 billion, so virtually no growth. Second up is the most exciting bit about Cisco's finances: shares outstanding. In 2016, Cisco had 5.05 billion shares outstanding, but as of today, that number hovers around 4.22 billion. That's a 17% decrease, meaning Cisco is massively rewarding shareholders with a bigger stake in its business. Following that is free cash flow growth. Much like revenue, there's not much growth. In 2016, Cisco brought in $12.69 billion in free cash flow. Last year, that number was $14.01 billion. This is still consistent growth, reflective of the company's size and the difficulty to grow. Next up is current assets versus current liabilities. Current assets stands at $39.11 billion against $26.26 billion in current liabilities, and a crazy $24.52 billion in cash on hand, meaning Cisco has nearly enough cash to pay off all of its short-term debts, a figure always great to see. Now we have the free cash flow valuation. If we take the last 5 years of free cash flow and multiply it by 20, we get an expected market cap of $277.2 billion. The current market cap is $248.7 billion, meaning Cisco is just barely undervalued from this model. The last two things I want to look at are 5-year return on invested capital and the dividends Cisco pays. The 5-year average ROIC is actually really high at 20%. I usually like to see this around 10% at least. Cisco is investing its capital at incredible rates of return. And finally, we have dividends. It seems Cisco is popular for its dividends, and I can certainly see why. Cisco's dividend yield is a good deal higher than the market average, standing at 2.52%. That's 37 cents per quarter and $1.48 per share per year. This company's payout ratio also stands at a solid 43%. This gives Cisco good room to continue growing its dividends. Over the last 5 years, Cisco has grown those dividends at around 9.4% per year. All of this adds up to Cisco being a solid dividend growth stock. Having that look into Cisco's finances, I think, gives us a pretty good idea of where Cisco stands. Now, this is usually the part where I would go on about how I think Cisco is this hidden growth stock that's going to grow revenue by 50% per year forever. But let's face it, Cisco is huge. Even with the investments in the Internet of Things companies and its restructuring, I don't think think it's going to move the needle that much for Cisco. Sure, it'll grow, but it'll grow slowly and predictably, as we've seen in its revenue, maybe 2 to 3% per year at most. This presents a problem for investors if we want to only invest in growing companies and generally stay away from companies that are stagnant or on the decline. What do we do with Cisco? It's still growing, however sluggishly. Is there room in the average investor's portfolio for this company? The answer, I think, is yes. On average, Cisco has bought back 6% of its stock every year, leading to that impressive 17% buyback rate. While there is debate on whether or not share buybacks materially affect share price, I believe that over long periods of time, that the stock price will reflect those buybacks. Cisco has a 2.5% dividend. This gives the company an average shareholder yield of almost 9% over the last 5 years. Shareholder yield means the total of buybacks and dividends together. Despite its nearly non-existent revenue growth, Cisco is still able to give investors an average of 9% return on their investment every year. Overall, the company has done very well by its shareholders. That's where I think the real value of Cisco is, not in the extreme growth prospects, but in the consistent, every month, every year growth of your ownership in the company and the consistently growing dividends. Personally, I don't own the company, I already have too much tech in my portfolio, but still, I understand where the dividend growth investing crowd is coming from when they say they want to invest in these consistently growing, strong dividend-paying companies. In a sense, Cisco is security. I would be very surprised if this company weren't around in a decade. I think they'll easily be around for the next 10, 20, or 30 years. I weight a lot of my portfolio towards these high-flying, fast-growing companies like Corsair and Sprouts Farmers Market. With this weighting towards growth comes the need for safety, and I love these companies like Cisco and Intel because they're just chugging along, returning capital to shareholders in the form of buybacks and dividends. And that's perfect because that's all I need them to do. It's not just the safety that makes Cisco appealing though, it's also the sheer amount of cash they have. It's no secret on this channel that I both want and expect a market crash of significant size in the coming years. I don't want to be another market crash alarmist, but at this point it seems pretty inevitable. And what companies do well in crashes? Well, it's the companies with the most cash and the least debt. And I don't mean companies whose price drops the least. I mean businesses that thrive in turbulent markets. The companies with the most cash will be in the best position to make deals. Look at what Warren Buffett has spent a lifetime doing. He made deals, bought dozens of companies in times of crisis, and profited enormously because of these deals. He took struggling companies like Duracell and BNSF Railroad and turned them around, and he made a fortune doing it. This, I believe, the case to be for many companies today, but Cisco in particular. The best deals are right around the corner, and they've already survived the tech crash of the 90s, and they have $24.5 billion in cash, meaning that Cisco has the best opportunity to profit when the incoming crash eventually hits. Cisco has been very transparent about wanting to profit from these Internet of Things companies, and I think they'll certainly be one to watch when the potentially lucrative deals start. All in all, I think Cisco is an amazing company that investors should seriously look at, not for the exceptional growth, or lack thereof, but for the consistency of the business itself. It has a long history, one that's integral with the history of the internet, if not the very foundation for it, and it's survived and steadily grown despite the crash of the 90s. With all that the company is doing to greatly benefit its shareholders, I think Cisco could have a place in any portfolio. And I hope you enjoyed this video on Cisco. Leave your thoughts on the internet tight in the comments section, or have a conversation with me in my community in my Discord, link in the description. Until next time, I'll see all of you in the next episode of Dollars and Cents.